The Hedgeless Horseman here. It's August 16th, 2022. This video will be a bit about everything. First of all, I'll start out with a bit of investing theory. I've stated this before, but I don't think anyone should have much in terms of fixed rules at all. Because, I mean, there's a bunch of people, and that goes for some newsletter writers as well, who argue that, you should sell half the position after a double, for example. I mean that's kind of mind blowing to me. Apparently, it makes sense to a lot of people, but I don't get that at all. I mean, many cases are actually better uh, after they've gone up 100%. And like we know, I mean, all the success stories in exploration, making it sound like there are many, but the few really big success stories out there in mining. I mean, Great Bear, obviously, the one that I've talked about quite a few times. Uh, the big money is not made on the first 100%, the pop on the discovery, for example. It's made the next, let's say, 2-3 years after the 100% pop and discovery. So I mean, depending on what actual size you already have, I don't think it makes any sense at all to have a strict, strict, let's say, downsizing of a position. It should always be dependent, in my opinion, on what's the risk reward, what's the relative risk reward to relative to all your other holdings, because there are many cases where I have doubled down after a stock has gone up. I mean, I'm typically, I love catching falling knives, and I mean, like in the recent past or the last 2 years, I mean, everything has been pretty much catching a falling knife because almost everything has gone down. Uh, but I don't care if a stock is going up or if it's going down or anything like that. I try to strictly limit my focus to price I'm paying today and what the value I think the company will have in 1-2 years, for example. But in terms of like portfolio allocation, for example, I mean, you see it all the time. People, especially the one that are already doing quite poorly. I mean, as we know, I mean, the reason for haters, or the, let's say, prevalence of haters in this sector, I mean, it shouldn't come as a shock because this is one of the hardest sectors to actually beat. And people tend to lash out and try to tear people down when they're not doing too well. Because if you're doing better than other people, you're reminding them of, you're enforcing their self-image of them not being up to the task, that they're losers, etc. So most people try to tear you down. I mean, there's few things that people hate more than seeing other people succeed. And that's that kind of thinking, that if someone does well, that detracts something from you. I mean, that's loser. That's a loser mentality. That's a victim mentality. And if you think like that, if you hate on everyone that might be doing better than you, etc. I mean, you will never beat the market or anything like that because you will never take responsibility. All your focus will be not finding, let's say, wrongs in your own approach or whatever, not trying to figure out what is that guy doing well or whatever. It's gonna be trying to tear the other person down, which you think will make you feel better, etc. Because okay, sure, I'm not going up in the world, but neither are they, or I want to destroy their reputation or whatever. I mean, that's just a dark side of human nature, and especially when you have money and ego involved, like in investing. I mean, it's just going to be multiplied, pretty much. Um, anyway, so here's a, let's say, a model portfolio where you have how many stocks are there? 1, 2, 3, 4, 5, 6, 7, 8, 9. Can I even count? Yeah, that's 9. Okay, yeah, nine positions here. 8 of them 5% each, one 10%, and then you have 25 other holdings, each with a position size of 2% in your portfolio. Okay, obviously, like I said, I mean, I think you should have, uh, more money in the ones that you think are better, because otherwise, I really don't like if you have a fixed, like, I never have a more than a 2% position in any junior or whatever, because they're risky. Justify it in what way whatever way you like. That makes absolutely no sense to me, because there are for sure juniors that are like 1,000% better risk reward than another story. And in that case, you would want to have more in that. I mean, I think it goes back to the Pareto principle, and I think Stanley Druckenmiller has said it, and Warren Buffett, etc. I've talked about, like, you're probably gonna make 80% of your money in your 20% best cases. So I have a very large. My total portfolio is very diversified in terms of a lot of names, but I have quite high concentration in some of the names. And in this case, again, for example, you have 25 positions at 2%, and then you have some that are 150% higher, and one that is actually 400% higher. So let's look at a case here. This is your starting position size, and what happens next? Let's say all these 5%ers here, they're post-discovery plays. It's buying a company after discovery, and let's say fast forward 1 year, whatever, and let's say we're in a pretty crappy market environment. So let's say the pre-discovery plays, etc., haven't done much, or whatever they might be, micro cappers, poor beta plays, whatever. So they're down 50% on average. 50%, 25 companies you own are down 50%, cut in half. So that's a minus 25% to your portfolio. But let's look at the other ones. Okay, these are more high conviction picks, the 5%ers. And let's say 3 of them, yes, they had made a discovery, so you were in post-discovery, and over 1 year they went up 200%. So they're up to 15% each, these 3. These other 5, let's say they were only neutral. Didn't go down, didn't go up. And then you have your best case, let's say, which you start out with a 10% position. Let's say it's a slow grower, but a more probable grower, if you know what I mean. Let's say that's up 50%. So these stocks alone then amounts to 60%. And if they're up 200%, these 3, I would assume that things have just gotten better and better and better. So what started out as a discovery hole has seen follow through. So it looks increasingly likely that they will have something of significance. That yes, these projects have a shot of actually becoming a tier 2, tier 1 type discoveries. And of course, what people tend to forget is, like, I mean, when you look at the large acquisitions, etc., of the good deposits, I mean, the dollar per ounce values are much higher than you see in across the board in junior space today, for example. I mean, some of the monster acquisitions might be, for well, some are operating mines, but let's say I think Great Bear was like $180 per ounce, but I think you can see, depending on the stage, etc., but let's say $100 to $300 per ounce. But many that are not even close to being, tier 2 or tier 1 or acquisition, or they will not trade anywhere near typically $100 to $300 per ounce. So as these get de-risked, as a project gets better and better, typically the value per ounce should go higher, because it's getting increasingly likely that these ounces might actually be put into production, acquired, etc. And an ounce in the ground is worthless unless it gets pulled out of the ground. So it makes total sense from that perspective, that the closer a project is to reaching a critical threshold, the value per ounce should also increase. And as the likelihood of a takeover or whatever goes up. But again, if you have a strict rule like I'm gonna sell half my position on a double, who I mean that sounds pretty crazy to me, because again, like many cases actually are better after having popped 100%. So it's like let's look at some examples. Okay, this is actually 200%. I was like, okay, if you had, I'm gonna sell Western Alaska after 100%, whatever, you would have cut your position in half. Yes, you would have retained your stake, for example, but I mean, when they, let's say, started hitting, I mean, the recent wide intercept of 40 to 100 meters of massive sulfide mineralization. I mean, that all of a sudden looks like, okay, that case jumped a notch. Obviously, price jumped a notch. And after the actual news was out, I mean, it's just been going higher and higher. And they did a big financing, etc. So it's like, I'm more happy. I think, I don't remember how much I started out with in Western Alaska, but I think my position was up to I think I was up like 400%. Yeah, yes, I think it peaked at around 500%. But I've taken some profits up here, because again, it's like, yes, I don't think you should be too quick to sell, but obviously if a position gets seriously bloated, I mean, you can still be super bullish on a company, but you don't need to have 70% of your portfolio in it. But anyway, if you have just a strict rule, let's say that I'm gonna sell half after it doubles, maybe the case is a lot better here, that even after a double you add 50% because you like it that much. Maybe it started out as a 2% position, and then stuff happened, so you thought, hey, I should get a 10% position in this, and that might be totally justifiable because the case got so much better that the intrinsic value or expected value jumped so much more than actual price. So even if the share price went up 100%, maybe the expected value on the stock went up 200%. Then that's obviously a 100% price to value arbitrage. So you should be buying in that case, unless you have a better story, for example. Same with Snowline. I think, I mean, I've been talking about this stock for quite some time. I mean, but it's not until recently. I mean, especially the last news release, I would say. That I think, I mean, just this time period here. Yes, it's been going up, up, up. But some movements might have been. I mean, I would say I didn't understand the case enough to get a sizable position. But now that I've made if you might have seen, I put out a piece today. So I think it's like the risking efforts has gone up a lot with the visuals in the with all this. This is visible gold marks, but it appears that visible gold isn't the best predictable grade, 4 grade. But if we just look at vein density, then this looks incredibly fascinating to me, because like I've showed here on Twitter, this is my base case. I can't guarantee at all that this will come anywhere close. It might come in at 0.3 grams per ton, or there will be no gold, or whatever. But this is like my base case. Thick intercepts of so let's say 0.73 to 0.47 grams per ton, which would be huge gram meter intercepts. And that's based on some, in my opinion, conservative calculations. But if you look at blue sky, this interval here, I think actually I might have this off, and it should actually be just this length here. But you can see it's like, okay, light orange and some dark orange. That's the heat map or coloring for vein density. The hotter the colors, the more veins per meter. So about this intercept, actually graded 2.14 grams over 58.55 meters. So this is like 2.14 grams per ton, which corresponds with where the vein density is. And I don't even think there was any real visible gold traces here. Maybe one or two. So it might not have appeared to be as good as for example, the holes that are going like this, because they had much more visible gold. But still, I don't think their intercepts beat this here. And this had two instances of visible gold, and there were in fact two pops, etc. But even the background grade was like 0.55 when I took out the, let's say, nugget effect. So I guess the thing is that currently what we know about this system, it appears that it is in fact vein density, which Dr. Hart, who is also on board with Snowline, that was his conclusions on his research paper he did while working on, or after examining Dublin Gulch and the Fort Knox deposit, that vein density seems to be the best correlator or predictor of grade. Okay, then if that's the case, and I mean, look at this. So if this is like 2.14 gram, this, light orange to dark orange, I mean, can you see the grade potential in these holes? Dark orange, some have dark orange over, quite considerable widths, and they even have red coloring. Red coloring is, I think, at least 15 veins per meter, and I think light orange is 5 to 10, and dark orange, this kind of here, is 10 to 15. So it's not a doubling or quadrupling, whatever, but it's a step change. So 5 to 10, 10 to 15, and red is 15 and higher. So it's a minimum 15. So could very well be if you look at the average, for example, and cap the veins per meter for red at 15, even though it's above 15, it would still, in that case, potentially translate to double the grade. I mean, all else equal. So if this was like 2 grams per ton, I mean, you can imagine. I'm not saying that's going to be the case, but I'm saying that, okay, if base case is pretty much good enough, I would say, I mean, close to it at least. What's the blue sky? What's the upside potential in these holes? Yeah, if we just go by vein density here. And of course, what will be even more interesting, that these will be the first assayed holes from actually within the intrusion itself. So I think there's some skepticism, like, yeah, okay, these hits were outside. What happens if we hit inside? That makes some sense, of course, because it's a bit of a different environment. All with that said, I mean, some of these holes did cut the intrusion, but more, more narrow parts of the intrusions, fingers crossing through this, and they were gold bearing there at least. And what we know about Fort Knox, for example, is that in the Fort Knox deposit, basically the gold mineralization is strictly limited to the actual intrusion, and it's the intrusion itself that had the gold bearing fluids, that when the system cooled down, it released said fluids, and that's why you have the gold in the now quartz veins. So all of the gold that was in the granite when it was in magma form, that couldn't stay in the rock as it hardened, so it blew out all of the a bunch of fluids with the gold in it. So the granite today, when it has cooled down, is actually barren, and it's the veins that has the gold that used to be in the actual rock that forms the gold bearing veins. So in other words, it is this intrusion that is the likely, that's supposed to be the source. So I find it kind of weird if you have this huge source of gold, the source for gold, it cools off, and all of a sudden there's gold way up here, but if this was actually the source, why shouldn't there be gold in here? And we of course know that there's a bunch of VG within the intrusion. I mean, I think hole 10 here has like 210 instances of visible gold. So I mean, I think that's just we being a bit paranoid. So I don't see any logical reason why uh, these holes here shouldn't run. And what we know about the vein density and grade so far, I mean, for Fort Knox and Dublin Gulch, that was the best predictor. And we know that this, which has some bit more orange, etc., is actually grading 2.14. I'm not sure exactly how much this behind here is grading. I mean, it looks to be some light orange and some dark orange as well. So maybe this is an occasion where it is actually a bit higher than the other areas, which show the same colorization, let's say. But I'm open to the idea that some of these intervals could have, up to, I don't know actually. It's like what, 2 to 3 grams per ton. I mean, these are very long intercepts, and I understand that a lot of people are waiting for the assays, and that's what everybody. I mean, instinctively, for that's what everybody's been trained to do, pretty much. I mean, we're looking for barn burner holes because everybody knows it's the assays that move the market. In this case, I think it's the context that's the most important thing. I mean, sure, this might be a barn burner hole, but if every other hole pretty much is pretty poor, that's not a big thing. But if all of these holes are pretty decent, then we have, I think, a massive, massive system. I mean, 10 million ounces plus. So I think the size of the price will be more important than any particular asset, because let's say these come out with 1 to 2 grams per ton, and all of these ones come out at 0.3 grams per ton. Yes, these are barn burner holes, pretty much. I mean, hundreds of gram meters. But that's not going to make a major mine, and you're not going to build a major mine, I think, in this part of Yukon if you have, I think you need around 10 million ounces. But if these come out pretty decent, etc., and I don't see a big reason why. I mean, if you're hitting gold here, 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 all the way up here, all the way up here, the ones that are tested here, why shouldn't there be gold here, here, and between, etc.? I mean, these are pretty much blind holes, so it's like if they all show solid gold numbers and they are blind holes, I mean, either they must be extremely lucky or this is a very robust system. I think it's a very robust system because, as Dr. Hart has stated, the expert on these types of systems, he has not seen veining as intense as in some of the core from this valley target. But at the same time, I mean, there's a bunch of drama today on mining Twitter because obviously Snowline has been pretty much kicking everybody's ass. Snowline has just kept on going. This is a nominal short. This is a log short. So it's been climbing, and it's like, I think today was the highest close. Yeah, today was the highest close. So Snowline is at all-time high. How many stocks do you know are at all-time highs? Not many. How many people do you think are suffering over the last 2 years and do not have a stock that's anywhere close to all-time high? 99%, I think, or over 99%. How many do you think actually beat the market? Less than 5%, I would say. So going back to the, hater, loser argument, etc. The ones that I know that I think are great investors, private investors, and actually beat the market, I never see them bash any stock or anybody really. I only see that typically from people that I am pretty sure are absolutely absolutely shit as investors. So it makes perfect sense why they also would be the most agitated, basically trying to tear down every stock that's going up because they're not on board. Everyone else that's doing better than them because they, it makes them feel like shit, etc. And this is, I mean, this is what you see in every high flyer, let's say, and you saw that in Great Bear as well. I mean, you can only believe. I've showed the chart before. Great Bear. I mean, it had periods of, I don't know, 6 months to a year where it actually traded sideways, etc., and then it got spurted higher. So uh, there's continuously from here on out. It's like if this is turning out to be a kind of discovery as we hope, there's gonna be so much fear and doubt that's gonna be spilling all over. So we're gonna be, because everybody that is missed it is praying that it will go down, and they're gonna try to influence everyone else, of course, because nothing hurts like a missed boat, let's say. So there's gonna be a we're gonna have to climb the wall of worry, and of course we don't know if every what's gonna actually materialize from these holes. So that's the fun part of it. However, it's like I've said this before. I mean, typically, especially in a pre-discovery drill play, I like to take considerable profits if the stock has ramped going into assays. This is, in my opinion, not a grassroots target, because we know what these hit, and we know this information, how the veining looks, and we know how these systems tend to be, and we know how much VG are in some of these. So it's like it confirms at least that yes, this is absolutely for sure gold bearing, because they can literally see the gold. So I'm more comfortable holding this one than most. It's the same reason why I'm comfortable holding Goliath, because they have such a good hit rate, and they had I would say economic or close to economic values in all previous the 24 holes they drilled previously. So I don't see the system changing for some reason, and especially when you look at the market cap of Goliath, I think it's a good risk reward to hold into assets. It's a post discovery play. Anyway, so as per, or a bit similar to Goliath, I think Snowline could do a quantum leap, because next batch of assays will be from within the intrusion. So at least we'll know that yes, it is in fact gold bearing, even though it's pretty obvious. And depending on how many holes, etc., we get, I mean, if some of these holes, if some hole here hits like, I don't know, 300 grams or 300 meters or 2 grams per ton or whatever, then we know there's a high grade core, the high grade trend here as well, and then ounces are going to be stacking up quite rapidly. So where I have a case where because they've drilled around 800, this is around, well, is this? I think maybe this is around 800 meters long, and like 700 meters from north to south. So if you have that kind of block, if it goes down 400 meters, they've traced it down to 430 meters already in one of these holes, then you come up with a number around 20 million ounces or something, and that's assuming 1 gram per ton. So if some of this stuff runs at perhaps 2 gram per ton, obviously we need half the tonnage in that case. I mean, if everything here would be 2 grams per ton, I'm really not saying it is. I'm banking on around 1 gram per ton. But in that case, obviously you would need half the footprint to reach 20 million ounces in that case. So I really like the risk reward here. And of course, again, like we see on Twitter today, everybody that's not in the stock and haven't been along for the ride in the stock, they're out there in full force, hating and basically saying sell, sell, sell. It's gone way too high, bashing on Quinton, bashing on Crescat, that you can't say, there's a 55% chance of 50 million ounces or whatever. In some respect, that's a moot point, because maybe 55% is, too high. But if it's pricing in 6% chance of that happening, you're not paying for the 55% anyway. So I mean, if you just think, what would, okay, if this is mineralized, let's say that would be at least worth 20 million, I don't know. If it's worth 3 billion, 10% chance of that is 300 million. That's what we're pricing in right now in that case, around 300 million. Do I think there's a 90% chance of that not coming to pass? I think it's higher than that. I think it's at least a 50% chance of it finding something worth 1 billion. That's my personal, I think, conservative estimation. In that case, that would be 500 million, and it would still be, 66% undervalued at this price. So that's why I'm comfortable holding into assays, because for this 800 by 700 meters, 1 gram per ton, 400 meters deep, if that's not to materialize, these holes would, be quite, I wouldn't say worse, but, well, if you look at a waning, I mean, if this again is 2.14 and this here is like, 1.77, or I don't know if it's the entire length actually, it might be the entire length, but that's like, a lot of yellow actually, and this is around, I don't know, 168 meters or 150 meters of 1.5 grams per ton, whatever. So if you just compare the coloration here, for this to be really crap drill holes, it rests on the fact that, okay, vein density all of a sudden is not a good predictor for grade. So it's actually have to be worse in terms of gold grade, in light of vein density, because there's typically higher vein densities out here than in these holes. So if there's better vein density, then the actual mineralization in terms of gold per vein must be worse than this. And if it's, twice as much veining, for example, for it to be worse than this, let's say it have to be 75% less gold per vein. I don't think that's likely. And again, it's like all the critics, whatever, all the haters you see on Twitter, etc. Believe me, a tiny minority of them actually beats the market over the long term. That I'm pretty damn sure of. But like we know, nothing stops people from sharing their shitty opinion freely. I know I have beaten the market. I trust. Why should I listen to, let's say, take advice from a bunch of people who I think there's a 99% chance that they have had worse results than me? No, I'll stick with my guns. There's no guarantee that Snowline will work out, but my portfolio is not rested on one particular case. I took a big bath in Nova, obviously. I took a big bath in White Rock, for example. But there's other stocks that have done well. So it's like you're never gonna have a 100% hit rate, and that's I guess what I'm trying to show with this example. If you have a few pretty good cases and you let them run over years, etc. If all these here went up 100% more, for example, this alone would be 30% of your starting portfolio. This would be 30% as well. So they would combine be 60% of your entire portfolio, and then all of these 25 stocks at 2% each starting position could go to zero, and these two would still have paid for them. And what we know again about Great Bear, said, they're not stopping a store like that after a discovery. If it's a solid discovery, they can go up 1,000 to 2,000% over 3 years. So if one had the stomach to hodl some, large positions in good cases that only got better, they're gonna pay for all of your mistakes. So I expect maybe 4 stocks I own will provide most of my returns, let's say. And again, it's like, okay, this, let's take here, for example, if you had a rule of 100%, you would have sold Eloro here if you got in early. 200% you would have sold around here. And Eloro just kept, getting better and better and better, making discoveries. I think it was way better here, for example, than it was here even. So I had a bigger position here than here. I have a bigger position now than I had here. Goliath, yes, it looked really good, and I had a pretty sizable position from the get-go because it looked like growth was probable, because they had outcropping mineralization. They could see the actual ore body outcropping. I have a I think a bigger precision now in Goliath than I've had at any time before. They just keep hitting and hitting and hitting. So if I would have sold most of it, it's like, yeah, I'm gonna stick to a 2% position in Goliath or whatever, or sell on a double. I mean, I wouldn't have been along for one of the, in my opinion, best exploration cases here. Not with a sizable position enough, because there are not too many instances where you find these, like, which could be seen as head and shoulders above others. I mean, for I would. I mean, there's some junior explorers, like maybe I could have a 5%, 0.5% position in them, but maybe I would have a 10% position in Goliath, and I thought that would fair. That would mean, like, yes, I think Goliath is like 20 times better from a risk reward perspective. Not that it has 20 times the amount of upside or anything like that, but when you combine the potential and the probability of potential and yada yada yada, it's like SK as well. I mean, if you sold these, at a pop of 100%, that would be here. I mean, I think, as with the Laura, I mean, I think SK has just been de-risking and de-risking. But SK was never too cheap to begin with, I think. I mean, I thought it was kind of expensive back here because that was before they had even drilled. But I mean, lo and behold, the thesis Quinton and Mac had, I guess primarily Quinton, I mean, appears to have played out. They have more targets than ever. They have more potential strike than ever. But again, it's like, yes, it's not the cheapest one out there, but on a long enough timeline, do I think SK is going to prove up something for sure. They have like 15 kilometers of strike to work with, but at the same time, yes, this is VMS exploration. VMS is not the most predictable of deposit types, so they have huge amount of blue sky, SK Mining, I think. Not that anything is guaranteed, but obviously if you have 15 kilometers of potential strike, whatever, that they know of now, and that does not cover the Excelsior trend or Ciblulu or Vermilion or C10, etc. Yes, they have their hands full, basically. But yes, it's kind of expensive to drill up there, and of course to tie a resource together, etc. You would need more close-based drilling, and this is still exploration drilling, and these VMS systems are tricky. So you have that's like on the negative side of things, but they have a very long runway, I would say, because they have so much land, they have so much discovery potential. But if you come, like I showed here in my case for Snowline, what I really like about Snowline, for example, and the same could be said for like Loro and in some respect to Goliath, is that if you have a huge disseminated system, it doesn't take too many holes here to infer an absolutely enormous ore body, or an enormous deposit anyway. So if you put in like, I don't know, 15, 20 holes here, it might be blatantly obvious that this is like 10 to 20 million ounces at least. There are not many systems in the world where you can put in 20 holes and infer a multi-million ounce deposit. Some of the more nuggety vein systems, you might need to drill 20 holes to prove up 200,000 ounces. So that's what I really like about Snowline. That just from this campaign alone, again, kind of like Goliath, there could be an absolute quantum leap in a very short period. When this field season is over, then we will know what these holes assayed and the other ones they've drilled, and they're going to be drilling at grazing down here. So there's different scenarios that could play out. There could be shitty grades in all of these holes, and you'll see the stock down 50% or more. That is a possibility. I don't see it likely, but there's also a possibility where these holes that look really good are quite good, and they hit on more holes that they're gonna drill. And within 6 months we will have an idea, or maybe it will by then be obvious that this is like 10 to 20 million plus, because I assume it would be open in that case, million ounce deposit, which would put it among one of the largest gold deposits in Canada, and possibly with pretty good grades. And if you factor in that Gracie might be a hit, then you can just imagine what might happen to the stock, because that would put it as, I think, a tier one, type discovery, worthy of the biggest, the largest gold miners. We don't know that. That's of course the whole point of speculation or investing. I don't think it's priced in enough. At 300 million, yes, sure you can. That's, I think, fully diluted, or maybe it's actually, yeah, around, let's say 320. Let's say it's pricing in a 30% chance of a deposit worth 1 billion. And let's say at 5 million ounces, it will actually not be enough to warrant putting a mine here, because it's so remote. So in actuality, 5 million ounces will not be worth too much. But if we get if again these holds, and it would become obvious that it's going to be 10 to 20 million, then the value per ounce is going to take a quantum leap as well. Because if 5 million ounces isn't worth that much, but 10 million ounces is the threshold. If we pass 10 million ounces, the value per ounce all ounces will go up in that case. And that's obviously, again, no guarantees that, we have no idea what actually will happen. It's just based on all we know that makes me think that the risk reward here is very favorable, because the size of the target, the characteristics of the target, how much gold you could infer from just a few holes, what we know about the veining, that we know there's visible gold running through all over here, etc., makes it a very convincing target, and great risk reward in my book. Risk reward, not guaranteed reward. Risk reward. And just looking at the chart, it's been basically stair-stepping, etc. And today I released my piece. It got a bump on that, and there was some selling. The thing is, there's probably some people who are in quite early, and they might be sitting at absolutely bloated positions. So even though, yes, letting your winners run, but if some of these people who have been along for some time already, I mean, if you get up to a huge position, I mean, obviously you will pretty much have to sell some. You'll be closer to selling than buying, even though it might be the best case, but you're like, oh, man, I'm up to 20% of my portfolio in Snowline, or 30%. I mean, this is crazy. And we're gonna have assays, so they're probably gonna be more inclined to the risk, which is totally fine. To each his her own. I'm holding into the assays, but then again, what happens? I mean, we don't know what the market expectations are either. So maybe all these holes come out with like 1 grams per ton on average, and it's going to be quite clear. It's like, okay, yes, this is easily 10 million ounces. Maybe the first reaction by the market is to sell, because there's so much hot money in. So you have a dip, and then the smart money who like, okay, if there's 10 million ounces there and it's wide open, it's probably going to be 20, 30, and with 1 gram per ton, it's going to work or whatever. So they come in and buy, and then you have like the first profit taking, and then it's quote off to the races again, because some people figured out this is going to be a monster. That could happen, or the assets might surprise to the upside, because we have no idea. Only God knows what exact assay results would lead to let's say a neutral response. Anything above that, above expectations, would lead to an immediate jump. Anything below would be an immediately down. But the important thing, again, because there's going to be huge swings, I'm pretty sure about that, is to be cool, calm, collected. Like, what the results we get, is the case intact? Forget about the first reaction to the actual assay results from a few. I mean, again, yes, we don't know. Maybe two will be spectacular and it's gonna jump 50% or whatever, but like maybe some are quite poor, for example. So it's like, yeah, 50% higher on two when the other ones are poor. It's like, I don't know if they risked enough for the case to be intact, or whatever. But at the same time, maybe all of these are pretty good, but it's not enough for the punters, the hot money. It's like who only went into the assays because they want to get rich tomorrow, which is, in my opinion, big mistake. So maybe it gets sold off. But if you're like, hey, I mean, yeah, okay, they weren't like 3 grams per ton or anything like that. There were no perhaps super barn burner holes, headline holes. But it's like, yeah, I mean, this is probably gonna be 10 to 20 million ounces. So in that case, hey, I mean, let's say market cap went down to 270 million, and you're thinking, hey, 270 million for like what is probably gonna be 10 to 20 million ounces. I mean, wow, what an opportunity. So then you can obviously take advantage of there being a sell-off because there's more hot money that's short-term oriented and don't see they're only looking at the trees, not the forest. Uh, yes, some of my thoughts. I mean, if you want to know more about Snowline, and my case for it, you can go to my website and read up. Uh, Long rants as usual. Thanks for listening, and as always, I mean, consider me biased. SK Mining, Goliath, Western Alaska are sponsors of mine. Uh, Western Alaska is a new sponsor of mine. Happy to have them on board. But I own shares of all companies mentioned, so consider me biased. There are no guarantees in this business. It's only risk reward. Don't bet the farm on any single play. Know why you invested. Know what you want to see. Take a long-term perspective. Don't buy Snowline because you want to get rich from the coming assays or whatever. That's gonna set a bad precedent, and then you're gonna start doing that stuff. And I personally don't like that. I'm in it for the uh, Great Bear story where it's yes, it goes up 50% down, 50% up, 60% down, 30% yada yada. But over next 1, 2, 3 years, I might be up several 100%. That's the way to play it. I think it requires a bunch of patience, but hot money never made money, really, at least in the long term. Again, consider me biased, not investing advice. Hit the like button if you like this stuff. Bye.